focus would be on the options trading strategies, with basically the focus upon as to how technical analysis that you already know. I'm assuming in this class that most of us understand or at least have a know-how of technical analysis. I'm not going to get into the basics of technical analysis because that is what I presume you would have already done, being a member of ATMA or being in this particular field. At the same time, I'm not going to get into the basics of options. So I'm assuming you already know what a call option is, what a put option is, and things like that. And having known these two areas, having known what a technical analysis is and having known what a simple call option and put option is, how do we amalgamate these two things together in order to come up with trading strategies that can be profitable in the area of options trading? That is what is going to be the basic focus over the next 2.5 hours of this particular session. The first and the foremost, most important thing is technical analysis, and to me, basically, technical analysis essentially means 2 or 3 very different things. One, basically, it is about price series analytics. You've got prices, you've got the LTPs, you've got the OHLC prices and things like that. The price in a particular pattern, you either draw a moving average out of it, you draw a RSI out of it, you do a moving average convergence divergence, you do a Bollinger Band, you do all sorts of price series analytics on the prices, and you come up with different frequencies, hourly candles, 2-hourly candle, half a day candle, 1-day candle, and you have certain frequencies that you would like to basically trade. That is what basically technical analysis tells us. Idea of basically extending this to the option space is that in the options, when you talk, for example, theta, can we do some kind of price series analytics, not just on the premium prices of the options, but at the same time some of these Greeks in order to come up with a profitable strategy, right? So the first idea is basically to identify the price series analytics just the way we do in the technical analysis and extend it to the option space. That's the first thing. Second thing is basically, what basically technical analysis teaches me is related to rules. You try and make rules whenever you talk about technical analysis. You're trying to talk about entry signals. You're trying to say that whenever the fast moving average crosses over the slow moving average on the way up, you're trying to basically have a buy signal. Whenever it crosses on the way down, you're saying you have a sell signal. Whenever your price reaches the upper Bollinger Band, you say that the price in the short term has become too much overheated, so probably you should do a mean reversion from there. I'll be using a lot of technical jargon, so ending to basically your in the option trading all the Greek. Alright. Now, I just want to know from the crowd, are you okay with me using words like theta, or do you think that that needs an explanation? I mean, how just a normal yes or a no. Are you okay with that? Okay, all right. So I can proceed further then. All right. Now, when you talk about basically option shorting, one of the biggest problems which occur is basically how do you manage the risk, right? So the first thing that we will do is we will talk about the entries in the exit signals for shorting of an option based upon a very different kind of a thing that probably would be something new to you, right? We'll be using some rules, right? We'll be using rules just the way you use rules for technical analysis. We'll be using the rules for shorting of an option and basically understanding that how do you manage the risk, on shorting. What happens is, if you're a trader or if you basically happen to talk to your client, most of the time they'll say that, I want to make consistent money out of the stock market. I know there is risk involved, I know there is everything out there, but can I make sort of a very consistent money, probably a 15%, a 17%, a 20% kind of a return, in the market, irrespective of how the markets are behaving. And one of the classical ways of basically doing that is either by shorting a straddle or shorting a strangle. Now again, can I use straddle and strangle as a word? Yes. I can. All right, fantastic. All right. Now when I say we are shorting basically a straddle or you're shorting a strangle, what you're doing is you're essentially shorting. If you're shorting a straddle, you're basically shorting an at the money call and at the money put, right? And if you're shorting a strangle, you are more often than not shorting one out of the money call and one out of the money put, right? Most of the time what happens is once you've shorted the strangle or a straddle, most of the time what people do is they try to look at the volatility and say that, if the vols have started spiking or have started going up, cover the straddle or cover the strangle. If the vols have continued to stay low, just stay in the straddle or strangle. But there is no specific sort of a rule or a guideline, which I have at least seen with people as to how do you manage your option shorting space and at the same time manage do the money management thing very effectively. Alright, so the first thing that we are basically going to introduce when we talk about option trading strategies is the concept of delta. Alright, so the first Greek that we are going to, and I'll take another 5 to 10 minutes of yours to help you understand this concept of delta, because this one single thing apart from the gamma and volatility vega would help you develop a lot of trading strategies with a lot of efficiency. Right? Now, in very simple terms, what does delta mean? Delta is basically how much, or what is the percentage change of your instrument with respect to 1% change in the underlying. Alright? So when I say, for example, Nifty futures, what do you think is the delta of a Nifty future if I am going long a Nifty future? 1. So the delta of Nifty future, if I am going long a Nifty future is 1. Why? Because with every 1% change in the underlying, which is the Nifty index, my Nifty future would also more or less move up by 1%. So if my Nifty index goes up by 1%, right, leave aside the interest factors and everything, more or less even the Nifty future would move up by 1%. If I'm short Nifty futures, what do you think is my delta? -1. If I'm short Nifty future, my delta is -1. Because if Nifty, which is the underlying index, moves up by 1%, my PNL would basically go down by 1%. Right? So if I'm short Nifty future, my delta is -1. If I'm long Nifty future, my delta is 1. Delta has a property that it lies between +1 and -1, always. Alright? It will never be more than +1, it will never be less than -1. So let's talk about delta in terms of options. Simplest way of understanding delta with respect to options is the probability of that particular option ending in the money. Delta, by definition, is the probability of an option ending in the money. Alright? So let's assume that I take one at the money call. Alright? Let's assume market right now is at 9,000. So I take a 9,000 call. What do you think is the delta of a 9,000 call? What do you think is the probability of this 9,000 call ending in the money? 50%. Sorry? 50%. 50%. So if you see at the money call, you have marker. Everybody can see this? Alright? So if I take a 9,000 call and my market currently is at 9,000, alright? Everything else remaining equal from today till the time of expiry, let's assume that you don't have a view on the market, let's assume that everything else remains equal. There's a 50-50% chance that whether market would rise above 9,000 or fall below 9,000. I'm saying everything else remaining equal. We are not talking about the budget here. Right? We're just talking about normal, pure mathematical term. Right? So a 9,000 call, which is at the money, has got a 50% chance of ending in the money and a 50% chance of ending out of the money. Why? Because if the market expires below 9,000, this 9,000 call is going to be out of the money or in the money? Out of the money. If the market expires above 9,000, this 9,000 call is going to be in the money. Right? So there is a 50-50% chance of this particular call ending in the money or out of the money. So what do you think is going to be the delta of this particular call option?